So I'd like to start off by just getting some information from you guys and inquiring what about derivatives do you guys find confusing, or what about derivatives challenges you the most, so that I can try and take an approach today when going through this lesson to better assist you in understanding. So if you guys can just take a minute and just post for me in the chat more or less what you find challenging about derivatives. And in the meantime, we'll wait for the rest of us to join. So while you guys are responding, I just like to tell you guys, or I wanted to suggest an approach for today. So like I've prepared this presentation, but obviously, or like I would suggest to you that you have a pen and paper with you to make notes of what is being said verbally, because I feel that the brain absorbs better when we write. So when we listen and we write, the information goes into our brain and stays there a lot better than when we're just listening. And then when you go home and you're studying for the exam and you're listening to the recording and you're looking at the slides, you use your notes and it sort of refreshes your memory in a different way. So my strong suggestion today is that take your pen and paper, write down slide 1 and put any notes that you feel is helping you to understand the section better. I myself do this in my online classes, and it makes a world's load of difference. Okay, so Muthle says currently. Yes?
It looks like there's an end up. I think there's PG who has an end up.
Oh, okay, PG, you may go ahead. PG?
Sorry, that's an error.
Okay, no problem. Okay, so I see two responses here is currencies and swaps. So in today's lesson, unfortunately, I won't be doing too much on swaps. Hopefully we can, I won't be doing an actual calculation on swaps because I want to focus on futures and options, which are lengthy sections. And then in terms of currencies, today we're doing derivatives. So derivatives are, if I can get started, it's a contract, right? So derivatives, what is a contract? A contract is a piece of paper, right? So a derivative is a contract, which is a piece of paper whose value is based on an underlying asset. So the value of the derivative is based on a currency. Currency is an asset. If you have $100, it's an asset, right? So it's a contract which is based on an underlying asset or a group of assets, right? So an example would be bond, currencies, or an index, right? So that's what a derivative is. So it's basically a piece of paper, right? And why would people want this piece of paper or pay for this piece of paper is for two reasons, right? Is for hedging. So if you are in a business and you need to buy a specific asset in the future, or you need to sell in the future and you want to lock the price in today, so you know, okay, I'm guaranteed to get this price. Doesn't matter what the prevailing market conditions are, I want to lock in my price today. You are hedging, right? So you're protecting, it's a protective strategy for yourself, right? But the other reason, that was like, I think would be the base use of derivatives. But now what people are doing is that they are speculating, they're using derivatives to make a profit because they're selling at different rates at different times in the market. You can try and make a profit through a means called arbitrage. This is speculation, right? So we'll cover arbitrage in great detail today, but speculation is making a profit by buying and selling in different markets when the derivatives are selling at different prices. So you're trying to make a profit by speculating. Okay, so today we'll be covering the following derivatives, which is forwards. Under forwards, we will be doing, we'll be concentrating on futures, and then we'll be doing some contingent claims, which are options. So basically futures, forwards and options are our main focus for today, right? And then someone asked me on swaps. So there's a nice explanation for swaps here, which is where swap is it's a tailor-made agreement between two parties where one party pays a flexible interest rate and the other party pays a fixed interest rate, right? And the exchange takes place at a certain time in the future. So now we've broken down our derivatives into two sections. One are forward commitments and the other ones are contingent claims. So the first section we are going to focus on is forward commitments. So a forward commitment is exactly what it says. It's a commitment in the future where the terms are negotiated today, right? You get the types of forward commitments you get is a forward, right? Where a buyer will buy from a seller a commodity in the future at a price determined today. A forward is a private transaction between two people and there's default risk, right? So it's now just, it's a contract, but it's not regulated by a higher body, right? So it's a contract between you and a person. You all made this agreement and you're hoping that the person honors the agreement, right? But you get a future which is the exact same as a forward, but is highly regulated, right? By a futures exchange. It's traded on a market. So hence the person is obliged. There will be legal consequences if they do not honor the contract. There will be automatic legal consequences if they do not honor the contract, right? So that's why a future can be openly traded, like anybody can take it over within the market. It doesn't have to be like a forward, which is a private agreement which between two people for a specific item. So a future is something that can be traded on a market and it's highly regulated, right? And then a swap, like we mentioned, is a two-way transaction where parties agree to exchange a series of future cash flows. And like we said, one will have a fixed interest rate and one will have a floating interest rate, right? So these are the forward commitments that we'll be covering today. Is there someone I hear? Is there any questions? Okay, so now the best way to understand hedging versus speculation in futures, so we're focusing on futures, is to use an example, right? So the example I've got today is about oil. An oil producer needs to sell their oil, right? They use a futures contract to do it, right? This way they can lock in the price that they will sell at and then deliver the oil to the buyer when the futures contract expires. Similarly, a manufacturing company may need oil for making widgets. Since they like to plan ahead and always have oil coming in each month, they too may use a futures contract. So they're buying their oil on futures, so they lock in the price today, right? This way they know in advance the price they will pay for oil and they know they will be taking delivery of the oil once the contract expires. So this is a great way of protecting oneself and also planning ahead and knowing that, you know what, this is how much I'm going to pay for oil. So when I'm working out my costing and I'm selling my widgets, I know how to price them, right? But then you get another reason for investing in derivatives is speculation, right? So let's look at the speculation side of it. Retail traders and portfolio managers are not interested in delivering or receiving the underlying assets. So these are not the manufacturers or the oil producers. These are other people looking to make a profit somewhere else. So a retail trader has no need to receive 1,000 barrels of oil, but they may be interested in capturing on a profit that the price moves of oil. So basically, in terms of speculation, the speculator takes into account the spot price of the underlying asset, and he works out the theoretical futures price. So he does a calculation with interest rates, which we're going to do going forward. And then he sees, okay, you know what? I can make a profit from here by buying spot and selling in the future. Or I can say I'm going to borrow a sell spot, invest the money, and buy futures. So they engage in the contracts not to receive or sell the underlying asset, but just to make a profit from the price changes in these contracts, right? So we'll be calculating the futures price and the value of non-dividend paying futures. So you do get dividend paying futures, but we'll be doing non-dividend paying futures, and we use the following formula. So this formula is quite easy. So we're working out the theoretical futures price, which is your future is equal to your spot rate of the underlying asset times by 1 plus your interest rate to the power of t. T is your time, right? So it can be 6 months. 6 months will be 6 over 12, which equals to 0.5, right? So again, we are using exponents to determine our theoretical futures price. So the best way to explain this calculation is through an example, right? So let me just check. Is everyone with me? Okay, I see a smiley face, so everyone seems to be okay. So Jake Gray, right, believes he has identified an arbitrage opportunity for a commodity as indicated by the information given in the table, right? So arbitrage opportunity is best explained through this example, so we can see how you can make a profit by buying in one market and selling in another, right? So the spot price of the commodity is 120 Rand. The futures price expiring in 1 year is 125 Rand. So what does that mean? If you enter into a futures contract for a commodity, you will pay 125 Rand. You sign the contract now. In 1 year's time, you will pay 125 Rand for the commodity. And then the 1 year interest rate is 8%, right? The theoretical futures price is calculated as follows, right? So we take our futures is equal to our spot rate, which is 120 Rand, times by 1 plus our interest rate, which is 8%, which was given to us, and we get 129 Rand 60 cents, right? So what do we notice here? Theoretically, when we calculate the future value of this commodity, taking interest rates into account, it's 129 Rand 60 cents, which exceeds the actual market price. You're going to get to pay 125 Rand in 1 year's time. So now this is where we see this price difference results in an arbitrage opportunity. We can make a profit from this, right? So how can we make a profit of this? Let's have a look, right? So we buy a futures contract because it's a good price, right? We worked out that rightfully that commodity should be selling at 129 Rand 60 cents by the end of the year, but it's selling now. If we enter into this contract, we sign it down, we know we're going to get this commodity at 125 Rand, right? And you know also that your shares sell at spot at 120 Rand, right? So what you can do is you sell your shares for 120 Rand, right? So you sell all your shares at 120 Rand spot market now. You take the money and you invest it at that 8% interest rate, right? And at the end of the year, you're going to get 129 Rand 60 cents, right? And now at the end of the year, you've signed that contract. I'm going to buy this commodity for 125 Rand. But luckily, you have 129 Rand 60 to pay for it. So now once you pay for 129 Rand 60, you pay only 125 Rand, you left with 4 Rand 60 as your profit, right? So it's very little, 4 Rand 60, but obviously when you buy shares, people buy in sums. So you have 100 shares or 1,000 shares. So now if you had 1,000 shares, how much profit would you make? You can put for me your answer in the chat. Okay, so everyone is on, seems to be, that's correct. 4,600 is the correct answer. But the main focus here is to understand the steps to follow if you recognize an arbitrage opportunity, right? So this is how people use futures contracts to do arbitrage and also to buy commodities and lock in the price today. Yes? Was there a question? Okay, all right. So let's go to a question to see if we can understand what to do in terms of arbitrage, right? So let's look at our first question for today, right? The share of Valet Corporation is available at 200 Rand, right? So the spot price is 200 Rand. The theoretical futures price, this is what we calculate using the formula, is 240 Rand per share, right? If the futures contract is available at that point in time was 225 Rand, indicate the appropriate strategy that would earn an arbitrage profit, right? So if we look at this question here, a very similar thing happened in our previous question where we calculated the theoretical futures price to be 129 Rand in our previous question, right? Here they've calculated it to be 240 Rand, and we compare it to the futures contract which is selling in the market today for 225 Rand. So we see there is a opportunity to make a profit, right? So let's see what would be our appropriate strategy. Can you guys remember what do we do in a case like this, right? So I'd like to get you guys orientated when they say going long and short. Long means buying, short means selling, right? So these are terminologies that we'll be using throughout derivatives. Sometimes they'll say buy and sell, but long and short is the investment terms used for buying and selling. So if you're saying you're going long futures, you're buying the futures. If you say you're going short spot, you're selling spot and you're going to invest the proceeds. If you're saying you're going long futures, you're going to buy the futures. You're going to buy spot and borrow. You're going to borrow money to buy spot, right? Then the third option is you're going to short the futures. You're going to sell a futures contract. You're going to buy in the spot market by borrowing money. And the fourth option, you're going to sell your futures, right? You're going to buy the spot, and I don't know where you're going to get money to invest the proceeds. But these are your options. So if you just think of our previous question and just think of this commodity in your Valet Corporation, which is a share, in your mind, what's your strategy? What would you use? You can take some time to answer this question. Okay, so everyone has opted, or most of the participants for today has opted for option 1. So option 1 is correct, right? So you will buy a futures contract, you will short the spot, you're going to sell the spots and invest the proceeds, right? When you invest the proceeds, you're going to be left with 240 Rand at the end of the year, right? And you are going to buy the futures contract at, 1 second, R225, and you are going to make a profit, right? So I want you guys to write this down. This is called reverse cash and carry arbitrage, right? So in arbitrage opportunity for futures, you get cash and carry arbitrage, which is the opposite of this, and you get reverse cash and carry arbitrage. So what we did reverse cash and carry arbitrage. So you can write that down because it's important that you know this terminology when you questioned on it. When you see the term reverse cash and carry arbitrage, you know what we are talking about, right? So this strategy is called reverse cash and carry arbitrage. Okay. Now let's go to one more question where we will be using the formula to calculate the theoretical futures price ourselves, and we will be explaining the arbitrage opportunity again. And you can tell me, is it reverse cash and carry arbitrage or is it cash and carry arbitrage? So Elaine Pinto believes she has identified an arbitrage opportunity for a commodity and has gathered the following information. Commodity price and interest rates are as follows. So the spot price for the commodity is 100 Rand. The futures price in 1 year is 120 Rand. And the 1 year interest rate is 6%. So calculate the theoretical futures price to confirm this. And explain to me, what will you do? What will you do? Will you do reverse cash and carry arbitrage like we were doing previously? Or do we have to look into another strategy? So you can go ahead with that question. I'll wait for your answers on the chat. Can I ask Chokozile to mute, if that's okay? I keep on hearing some background sound. Thank you. Okay, so we've managed to calculate the futures price, which is 106, and then now work on your strategy, reverse arbitrage. We got the first answer here. We can get a few more answers and we can move to the next slide. Okay, so let's move on to the answer, right? So the answer is the theoretical futures price of 106 Rand, which everyone managed to get easily, right? Action will realize in an arbitrage opportunity. So the market price is greater than the theoretical futures price. So we have cash and carry arbitrage, right? Okay, so do you guys see that we're doing cash and carry arbitrage? Why is it cash and carry arbitrage? In our previous example, our theoretical futures price was greater than our futures price, right? Now, it's the opposite. Our theoretical futures price is 106 Rand, which is less than our futures price. Okay, so we can't adopt the same strategy, right? Reverse cash and carry arbitrage happens when, you guys can write this down, reverse cash and carry arbitrage is when our theoretical futures price is greater than our futures price, right? Our theoretical futures price is greater than our futures price prevailing on the market, right? That's when we do reverse cash and carry arbitrage, right? Now in this case, we have the theoretical futures price is less than the prevailing futures price selling on the market. So what will we do here? We do exactly the opposite, right? Okay. We now borrow money. We don't invest money, right? We borrow money because we're going to be only paying back 106 Rand, right? We're going to sell our futures at 120 Rand, right? So when we sell our futures at 120 Rand, we'll be receiving 120 Rand, right? So we buy spot now. We go borrow money, right? We buy at the spot rate for 100 Rand, right? Now we have to only pay the bank back 106 Rand, right? So at the end of the 1 year, we pay our loan back, right, of 106 Rand, and we sell our items we bought on the spot market for 120 Rand, and we make a 14 Rand profit, right? So are you guys with me? So you write this down. We say when our price is greater than our theoretical futures price. So this is price here. Maybe just get my pointer out. Can everyone see my pointer here? Okay, so here's my pointer. This is our price, right? That is our futures, right? So when our price is greater than our futures, we do cash and carry arbitrage, right? When our futures is greater than our price, when our futures is greater than our price, then we do, just give me one. Give me one. Sorry about that. Okay, so let's go back. When our price is greater than our futures, so our price is 120 Rand, our futures, theoretical future price is 106, we do cash and carry arbitrage, right? What do you do in cash and carry arbitrage? You sell your futures, right? You sell the future at 120 Rand, but how do you do that? You borrow money from the bank at the risk-free rate, and you go and buy spot. You buy spot, right? And now at the end of the year, you're only going to pay the bank back 106 Rand, right? And you're going to receive 120 Rand from selling at the futures price, right? So previously we did reverse cash and carry arbitrage. This is cash and carry arbitrage, right? Okay. So is everyone with me? You can stop me if you are lost. Okay. If everyone is with me, then we can go on to our next segment of derivatives, right? Okay, everyone is very quiet today. And this is supposed to be a section where we get a lot of questions. Okay, so just to conclude, if I give you guys a little bit of time to respond on the chat, is so basically in your futures, this is your main type of a question that you will be asked in the exam is cash and carry arbitrage, reverse cash and carry arbitrage, like your challenging questions. And theoretically, I'm sure you will be asked, there's a lot of options that you could be asked on. So make sure you read through it nicely and do a few practice theoretical questions as well. Okay, so now we go on to options, right? So options are contingent claims, right? So a contingent claim is different from a future because the future at the end of the contract, you have to deliver the underlying commodity. And now when it comes to contingent claims, it's a contract where the payoffs occur if a specific event happens, right? These are options. So basically in options, you have the right. It's a piece of paper that gives you the right, but no obligation to buy or sell an underlying asset at a certain date and at a fixed price. So here, in this case here, you won't have the same type of an arbitrage opportunity because you'll say, hey, no, you know what? The spot price at the moment is much better than the futures price of 120 Rand. So I'll rather buy spot instead of future. So you don't have to exercise. You don't have to complete the transaction, right? Basically, what you lose out is just a premium which you pay for this piece of paper, right? So you get a call option, right, which is the option to buy, right? And then you get the put option, which is the option to sell, right? So depending on your situation, you choose call or put if you want to buy something in the future or if you want to sell something in the future, right? So here's an example. You pay 20 Rand for a call option, right? So 20 Rand is the premium you pay for this piece of paper, right? And what does this piece of paper allow you? It allows you to buy an asset for a set price, example, 1,000 Rand, right? So when will you use this option, right? So now at a certain date in the future, right? When you're expecting the price of this asset to go higher than 1,000 Rand, this will be a good option for you, right? So you get a long call, which is an option buyer, and a short call, which is an option seller, right? But don't confuse yourself too much with this, right? But these are the scenarios that you get, right? Then you get a put option. This is an option to sell an underlying asset at a certain price, right? So example, you pay 20 Rand for the piece of paper to sell the asset for 1,000 Rand. When will you use this option? When you're expecting the price of the asset to go down, right? So If you're expecting the price to go down and you want to lock it in at 1,000 Rand, you will use a put option, right? And then you get a long put, which is the option buyer, and a short put, which is the option seller, right? Those are just your basics. So most of the time, the type of questions that you will be asked in terms of options is your option payoffs. So when you are using these options to hedge or to speculate, what would be your profit or loss, your maximum profit or loss, right? And the other question you will be asked is to use a formula called put call parity, right? So put call parity, basically what it means is that this 20 Rand which I'm talking about, which you pay for the piece of paper, for a call and a put on the same asset, they are related. So that's why we can put it into a formula. So they'll ask you, what is the price of an equivalent put? So put call parity basically helps you to price call and put options, the price for the piece of paper, which gives you the right, but not the obligation to buy the asset, right? So we were going to be working with two formulas here today, right? The other question I spoke to you about was option payoffs, which is a simple formula. The profit or loss you make is your spot price, less your excise price, less your call premium, less your put premium, right? So sometimes, and you can write this down, when a person is looking at an underlying asset or looking to make a profit, they can buy a call and a put because they're expecting, they don't know which way the asset is going to go. Is it going to go up or down? So now if it goes up, then we can buy at the certain price, and if it goes down, then we can sell at the high price. So you cover yourself both ways, right? But all you have to do is it's going to cost you a premium for the piece of paper, right? So you'll subtract your amounts that you paid from the premium to see how much profit or loss you can make, right? So now in terms of option payoffs, you say in order to understand options very well, you need to understand, right, the call option, right? A call holder, a buyer, can exercise his right to purchase an underlying asset should the spot price exceed the excise price, right? So you want to buy your 1,000 Rand asset, right? When will you exercise your option? If your spot price is greater than your excise price. So currently the market is selling this for 2,000 Rand. You have the option to buy it for 1,000 Rand. So you'll exercise your option, right? Okay. So these are just some of your basics which you can look at that will say, okay, my call option is an intrinsic value. It's in the money, right? My call option is at the money and my call option is out of the money, right? So if your spot price, currently your asset is selling at 900 Rand, so you're not going to exercise your call option. It's out of the money, right? Why would you pay 1,000 Rand when you can buy it on the spot market for 900 Rand, right? The only thing you lose out is your premium that you paid, okay? So this is a very nice simplified slide which just tells you what is your, what will you do in these cases? Will you exercise? Will you not exercise the option? Right? So you just look at your excise price and you compare it to your spot price, and then this is the decision that you will take on the right hand side, right? So you can always refer back to the slide if you want to confirm what is the strategy, okay? So these are option payoffs, and here we're going to start with our first example of option payoffs, right? So Eric Varvey bought shares of Investwise Limited. It has the market price of 95 Rand and the strike price of 100 Rand, right? He bought a call premium for 5 Rand. Calculate the break-even point for the call holder if the market price now increases to 120 Rand, right? So break-even will be your strike price plus your premium, right? So you know, okay, you know what, you add in your premium and you say, okay, you know what, if the spot price is at 105 Rand, I won't lose any money. I'll break even, right? Okay, but in this case here, the spot price went to 120 Rand. So you say spot price less your exercise price plus your premium, because we only took out a call option, right? And we made a profit of 15 Rand. So by having this call option, we made a profit of 15 Rand, right? Do you guys understand how we got the profit? Is everyone here with me today?
Yes, we are here. We understand it.
Yes, it's clear.
Okay, that's good. That's good. So you see the calculations are not too complex, but understanding the word problem is where sometimes we're getting a little bit confused. But if we just read it out properly or a few times, and we look at the previous slide where you can just reconfirm your strategy, I think you won't go wrong. Okay, so let's look at another example, right? Assume you have purchased a call option with a strike price of 60 Rand for 5 Rand, right? Your premium is 5 Rand, your strike price is 60 Rand. At the same time, you purchase a put option for the same share with a strike price of 60 Rand for 4 Rand, right? If the share is currently selling for 75 Rand, right? It's currently selling for 75 Rand, right? Calculate the profit or loss you will make from this option strategy, right? So what will you do here, right? So you say the spot price less the exercise price less the call and put premium is 6 Rand. But why do we say that? Because we won't exercise any of the options because it's currently selling for 75 Rand. So we sell spot, we receive 75 Rand, and we made a profit, right? We made a profit of 6 Rand. Okay, so when you take out a call and a put premium, you subtract both the amounts to calculate your profit. So here's a question for you. Thabo Khumalo purchased a call option with a strike price of 50 Rand for 5 Rand. At the same time, he purchased a put option on the same share. So he bought the option to buy at 50 Rand or to sell at 50 Rand for 6 Rand. If the share is currently selling for 70 Rand per share, right, calculate the profit or loss from this strategy, right? So it's very similar to the previous question where now you'll buy at 50 Rand because you have the call option to buy at 50 Rand and you'll sell for 70 Rand. So what will be your profit or loss from this strategy?
Hi.
Yes.
We have a loss of 11 Rand.
A loss of 11 Rand. Why would you say that?
No, it's because we have a S for 50 Rand, X and X for 50 Rand.
No, so our S is 70 Rand. If the share is currently selling for 70 Rand, what would be our profit or loss?
Okay,
Yes.
okay,
But
thanks.
see, our excise price on both options is 50 Rand. Excise price, where you see excise, it's the X, right?
Yes, yes.
There you go.
Okay, thanks.
All right. Okay. All right. Well done, everyone. I'm very impressed with you guys. We seem to be understanding option payoffs quite well, substituting well into the formula. So here is the solution, right? So we'd say 70 Rand is our spot rate less 50 Rand, which is our exercise price. We exercise that 50 Rand less both our premiums gives us a 9 Rand profit. Right. Now let's move on to a different formula called put-call parity, right? So we spoke about put-call parity is call and put prices with the same expiry and strike price, right? So like the previous question, we had the same expiry and the same strike price. Strike price is the same as exercise price, are related and they need to be consistent, right? So we use the formula to calculate the equivalent call and put prices, right? So it's both the same formula, but in some of your practice questions, you will see they have divided the 1 plus the interest rate to the power of the time, because here it's by, there we go, here it's by negative time, here it's by positive time. When you take it under, it will turn to positive, right? So any one of these formulas you use, you'll still get the same answer. And yeah, you can use any one of these same formulas, right? And it will be always advisable for you guys before you write the exam to make your own formula sheet. We will ask Mr. Matsoma if it's allowed, but in the previous years, we always advise go as you're studying through each section, make a formula sheet. Not a lot of notes so that you can copy or anything. It's just a formula sheet so that you can remember the formulas to use, because it's a lot of formulas going throughout this module, right? So here with these with this put call parity or with the call and put options, you can also work out the theoretical price and may have an arbitrage opportunity, right? So you sell high if it's on the overvalued side. But let's first focus on substituting into the formula and calculating the equivalent prices, right? So we say a 6-month European call option with a strike price of 40 Rand sells at a premium of 5 Rand. It has a risk-free rate of 8% and a current share price of 42 Rand. Using put call parity, what is the equivalent value of the European put option, right? So what we do is we substitute all our known values into the formula. So our spot price is given to us at 42 Rand, right? Our put value is what we are working out, right? Then we say our call value is 5 Rand, right? The call sells, premium of 5 Rand, right? Then we say our exercise price is 40 Rand, right? We can exercise the strike price at 40 Rand, right? And our interest rate is 1.08, right? And what do we have here? We say negative 0.5. Why is that? Because it's a 6-month European call option, right? So if you say 6/12 and you divide it, you get 0.5, right? And don't forget it has to be negative, right? So what you will do is you can first say 1.08 to the power of 0.5, negative 0.5, right? Once you receive an answer, you times that by 40 Rand, right? To get 38 Rand 49. If all of you can just please try that on your calculator to see if you guys get 38.49, then we can move on and say you bring over your 42 Rand to subtract it from this side and you say 5 plus 38.49 minus 42 gives you a put equivalent put premium of 1 Rand 49, right? So before I go on to the next example, let's see if everyone can get this value of 38.49. Okay, so the 0.5, we say it's a 6-month European call option. So in terms of our time, we say 6/12, right? So it's half a year. Our time works in years. So 6 months is half a year. 6 divided by 12 will give you 0.5. and you make it negative 0.5, right? Okay, but please put a note, Desiree, next to, if you have your piece of paper, and please try it out to that what I'm suggesting to you guys is do your exponent first, then multiply. Okay, so let's go to the next example, right? So we have a 1-year call option that has a strike price of 55 Rand. It expires once again in 6 months, right? And has a strike price of 504, and the risk-free rate is 5%.
Sorry, Yumna.
Yes,
Sorry. Can you just go back one slide, just a second? I want to see something that I missed.
sure, no problem. Okay, are we good with the previous slide?
Thank you. I'm good.
Okay, right. So example 2, we have a 1-year call option that expires in 6 months, right? So it's a 1-year call option, but we have the time to it is only 6 months. It has a strike price of 5 Rand, it has the price of 5 Rand 4 cents, which is the premium. If the risk-free rate is 5% and the current share price is 50 Rand, what would the corresponding put be worth, right? So this here, I'm using the formula which where you say 1 plus r to the power t. So it's our division formula, which you will get the same answer from, okay? So you say 55 Rand, okay, you say your spot price is 50 Rand, your current share price 50 Rand, plus your put premium is equal to your strike price of 55 Rand over 1.05, which is our risk-free rate, to the power 0.5, right? Plus our call premium of 504, right? So first we do our division, and we say 55 over 1.0247 once we've calculated our exponent, and then we add our premium and we subtract our spot price, okay? Because if you'll remember BODMAS in school, it's division and multiplication first and then addition and subtraction, okay? So you get the put price of 8 Rand 71. Okay, so let's go to the question 1, put call parity, right? The price of a European call option that has a strike price of 30 Rand expires in 6 months. So we have a 6-month option here, which is selling at 2 Rand. So the call option is selling at 2 Rand. The underlying share price is 29 Rand and the risk-free rate is 10%, right? Use put call parity to determine the price of a European put option that expires in 6 months, and here's the strike price of 30 Rand, right? So we can substitute into our formula, whichever formula you want to use, and then you can put your answers in the chat for me. Okay, we have an answer from Hopkins. Let's wait for a few more answers. Okay, Caitlin.
Hi.
Yes.
Yeah, I got 160.
160. Okay. All right. Let's receive a few more answers and we'll go to the solution. Okay, so 160 is the answer. Seems like everyone was on the same page. I am super proud of you guys, eh? Like I was always very nervous when it came to this section, and you know, it was always confusing for me, but you guys seem to be on the right page, and that's great, eh? So here's the answer. It will be 160. So let's try another question. A 3-month European call option with a strike price of 70 Rand sells at a premium of 6 Rand. It has a risk-free rate of 8% and a current share price of 73 Rand. Using put call parity, what is the price of an equivalent put option? Okay, we have a few answers coming in. Okay, so everyone seems to be on the right track, right? Your answer is 1 Rand 67 for an equivalent put option. Well done, everyone. Right. So now going forward, let's see if you really understand options by looking at the following questions. I just want to see how you'll approach the question to answer what will you do in this case here, right? So this is the big understanding of options, right? So you wish to obtain exposure to a specific share, right? Suppose that you buy a call with a strike price of 70 Rand at a price of 6 Rand 75, right? So a call option is the option to buy, right? Calculate the effective price to be paid to purchase the share if after 35 days it's selling at 65 Rand, right? So what would you do in a case like this? what would you do? Okay, so it's no calculation. You can just say, what would you do in a case like this? Okay, so what would you do in a case like this, right? Would you exercise the call option? What would you do? Okay, Hopkins says they would not exercise the call option. So now you will buy, what would you do, Hopkins? What would you effectively pay for this share? Okay, Natasha said she'll purchase at spot after 35 days. But remember, you paid a premium, right? Okay, Nobufle says the same thing. Any more answers? Because we need to know how to approach a question on derivatives in the exam, because all the questions are going to be different. Okay, so here is the answer, right? At the spot of 65, the call will not be exercised, right? The share will be bought in the spot market at 65 Rand, and you paid the premium to have the option to buy at 70 Rand. So effectively, you would have paid 71 Rand 75, right? So basically, that's the in terms of those two calculations, is everybody okay with options? Because majority of the questions will be based on those two sections. You can just give me an indication and then we can move on to our next calculation. Okay, so let's move on to the next calculation, which is option delta, right? So assume I've just basically dive straight into an example of how to calculate option delta, right? And then we'll talk a little bit about what option delta means and how it will be used in terms of your portfolio. So option delta has the following formula, right? If you look at my pointer, delta is equal to F plus minus F minus spot plus minus spot minus, right? So what is the plus and minus for is we are working the delta. Delta is a 3-point marking, right? Assume F plus and F minus is the way the share moves up or down. So if we read here, we say assume that at the end of 4 months, the price of a share is currently trading at 80 Rand, right? It will either move up or down by 5 Rand, right? So up will be plus, down will be minus, right? So it will move up or down. That's what we are going to have here, right? Okay. Calculate the delta of an at-the-money European call option with a strike price of 73 Rand, right? So delta, we break it down into 3 sections, right? So we have to first calculate F plus. So how do we calculate F plus? F plus is equal to spot price plus 5 Rand in this case, the up, okay? Spot price plus, right? Less your excise price. So in this case, spot price will be 80 Rand plus 5 Rand. It can move up or down, so we're moving the up. 85 Rand less 73 Rand, which is equal to 12 Rand. 12 Rand, right? So F minus, you work out the same way, right? You say spot minus, which in this case is 80 Rand less 5 Rand, right? Less your strike price, right? So it's 75 less 73, right? Okay. And here is where they worked out S plus and S minus, right? Which is your up and down movement by 5 Rand, right? So now we substitute into the formula. We substitute here into the formula 12 minus 2, right? 12 minus 2, which gives us 10, and 85 minus 75 gives us an option delta of 1, right? So what does option delta mean is it's a ratio that we have calculated, right? And what the ratio means is, just give me 1 second. Okay, so the delta ratio is, it's basically comparing the change in price of an underlying asset with the change of the derivative. So it's the change in the price versus the change of the price of the derivative, right? So in this case here, the answer will be 1, right? So you need to remember, put in your formula sheet how you calculate F plus, how you calculate F minus, how do you calculate S plus, how do you calculate S minus, right? So it's because it's got a 3-step process, it seems complicated, but not really, right? So this is your option delta. Okay. So then the next calculation that we have is option bounds, right? So you can be asked to calculate the lower and upper bound price of a 3-month European put option on a non-dividend paying share when the share is currently trading at 50 Rand. The strike price is 55 Rand and the risk-free rate is 8%, right? So you have a separate formula for your lower bound and a separate formula for your upper bound, right? So now basic substitution into the formula, right? Where we say our strike price plus, oh, please excuse that, our strike price plus our times by our interest rate. It's a 3-month European call option. So we say negative 0.25 less our spot price, right? Which we get 395, right? And upper bound, which is your strike price, 1 plus your interest rate to the power negative t, right? So we say strike price 1.08. So here you don't subtract your spot price, which is 53.95, right? So the upper bound and lower bound and delta calculation is all to do with our premiums, right? The highest and lowest value of our premiums, okay? So that's your upper option bounds, which is your upper and lower prices of the option bounds, right? So you just have to remember these formulas, you put it in and you calculate your upper and lower bounds of your options. So those are your basic calculations that we wanted to cover today. And delta and option bounds, you might get one, either or one of them, but option payoffs and put call parity are guaranteed questions in your exam, and you seem to be understanding that well. So you can just go through everything nicely. I would also advise you to look at your strategies. There's strategies when it comes to options, so that you can try to understand when are these derivatives used and how they can be used for hedging purposes and how they can be used for speculation purposes, which is also quite important to understand. So if everybody is feeling good about these derivatives, I think we are done for today. Is everyone
Fine.
good? Yes?
Yes, I'm fine with today's class
Yes.
and everything is well. So I
Yes.
have a problem with a
Yes.
total effect.
Total effect of?
The formula for total effect, if it's possible, you can explain for me.
You're saying total effect in terms of convexity and duration?
Yes, and effective duration.
Okay. So let me just go back there. Do you have a specific question that you would like me to answer, or you just want me to give you some information?
Yes, I have a question.
Okay. So now how do I get okay. So basically your total effect is your duration effect plus your convexity effect, right? So do you know how to calculate your effect, your convexity effect and your duration effect? Let's start there, right?
Yes.
So last week we learned how to calculate convexity and duration, right? Now, when they say the effect, we're turning it into a percentage form. So how do we turn it into a percentage form? We say our change in price is equal to our convexity times by our change in year, right? Our change in interest rate. It was like if it's 100 basis point, it will be 1 over
Yes.
100 squared times by 100, right? So
Yeah.
you'll have a convexity effect. So in terms of your question, what is your convexity effect?
Convexity is 210.
Your convexity is 210. And how many basis points does your question change by?
No, my question say consider a bond selling at par with effective duration of 10.6 years.
10.6%.
And yes,
Okay.
and convexity of 210. A 2% decrease in yield would cause the price to change by 21.2%. According to the duration rule, what will be the percentage price change according to the total effects?
According to the total effect. Okay, so I'm not sure if 210, I think you have to adjust your convexity to get it to effect, to get it to convexity effect, and you will do so by saying 210, right? And then your change in Y is, you say it's a 2% change to the, am I correct? Is that what I heard correct?
Yes, it's 2% decrease.
2.
Yes.
So we say 2 over 100 squared times by 100 to get an answer.
It's 2.
Is it 2?
Yes.
You're getting 2%?
Yes.
Okay, let me double check on my side. If you can just give me one moment.
Okay.
And what does your, because I get an 8.4% effect. Does your solution say 8.4%?
No, there is no solution here. It's just
you
a
have no
question.
solution. Okay.
Yes.
Can I ask you to email me? Can I ask you to email me? Yeah.
Oh, okay. Okay, I will email
Yeah, if you email me, but just for now, while everyone, and then I can respond to it on the discussion forum, I can work out a solution for you, just so that we're on the same page. I am not too sure how to get your question on here. And even if I just double check it with my colleagues before offering you an answer, but you have to make sure you have both answers in percentage form, which is your convexity effect and duration effect. How do you get convexity effect? You say convexity times by your change, which is your change, 100 basis points is 1, 200 basis points is 2, and then you put it over 100 squared, that's your formula, times by 100. In your case, I get an 8.4%. So then,
okay, can you please give me a formula for total effects so that I will try?
okay, so let me give you the formula for convexity effect, right? Convexity effect, right? Do you have your textbook? Why don't you look at the formula in your textbook?
Okay, no, I will check for total effects because I know for duration in convexity.
Okay, so you know. So total effect is right at the bottom. It's just before the chapter ends, where basically you just add your duration effect to your convexity effect, which is your two percentages. You add them together and then you use that to determine your price movement, right? Because convexity and duration, yeah, you just add them up and then you use that to determine your price movement, the effect on your price, right? Because that's what duration and convexity determines your price movement. So when you have higher duration and convexity, it means that your bond is more riskier because the movements can be higher or sharper. So that's what, but basically you add the two to get the combined effect, your two percentages.
Okay, thanks. I want to know that there is a difference between effective duration and duration of the bond.
No, I think we're just calculating one duration, which is called modified duration, if I'm not mistaken.
Oh, we use only one formula for them.
Yeah, just the one formula, right? So your duration formula.
Okay, thank you.
Okay, but you see what happens is when you see duration effect, you must work out the percentage from duration, the answer you get from duration, you work out the percentage, you work out the effect, and then you get the effect with the percentage, right? Then you can work out your percentage price change, but not effective and modified.
Okay, thanks.
Okay, all right. Okay, so I'm glad we could cover that. Okay, please put the question on the discussion forum and we can work out an answer for you. Okay, and on the discussion forum, because we're having live classes, please engage with us. Due to these live classes, I myself haven't been going online as much as I used to, but you guys can even let us know during revision classes what sections you'd like us to focus on. But from what I gather is we need to work on bonds. And yeah, if you have any questions that you are practicing that you don't know how they got the answer and you need an explanation, please mention it on the discussion forum so we can take it into account. Okay.
Hi.
So, yes.
Yes, I want to know that we will have this class until we will write exam.
I will be in touch with you because the exam date has changed. So initially, we wanted to take you through to the exam, but now maybe we'll space them out, or maybe we'll have to arrange with the lecturer on how to go about doing it. But
Okay.
basically, I'm thinking we still need to cover a good revision class for you before the exam.
Okay, thank you.
Okay, no problem. Okay, so that's it from me. If I don't respond on the discussion forum, which I will, you can email me. Here's my email address. And yeah, have a good weekend. And I hope you had a good class. Thank you very much. Enjoy. Bye.